The capital structure of a firm is an important managerial decision. The more debt the firm adds, the more it reduces its tax expense, but the more risky it becomes. The first area of capital structure we're going to look at is break-even analysis. This is used to identify the amount of sales a firm must make before it starts turning a profit. In general, a firm with more debt will require more sales before it breaks even. This is because it must cover the additional interest expense it incurs. We can use two different measures to determine when a firm breaks even. The first is EBIT break-even, or the earnings before interest and tax break-even point. This is the point at which a firm's EBIT, which is also called its operating income, is zero. The formula for the break-even quantity is Q star, that's what we call the break-even quantity, equals the fixed costs divided by the price per unit minus the variable cost per unit. The formula for the break-even sales or dollar amount is S star, so S star here is the break-even sales amount in units of dollars, whereas Q star was in terms of how many actual units we had to sell. So S star equals the fixed cost divided by 1 minus the variable cost per unit divided by the price per unit. So let's look at an example. Suppose a firm currently sells widgets at $15 per unit, and each widget has a variable cost of $4.50. The fixed cost per year incurred by the firm is $260,000. What is the firm's operating income break-even point in units? So we're looking for units, and the formula we want to use is Q star, the break-even quantity, equals the fixed cost divided by the price per unit minus the variable cost per unit. Well, the fixed cost is $260,000, the price per unit is $15, and the variable cost per unit is $4.50. So we just plug these into the equation. We have all the information we need, so we don't have to manipulate the equation at all. We just plug them in, and we solve for Q star. $15 per unit minus the $4.50 cost, it gives us $11.50 in the denominator, and $260,000 divided by $11.50 gives us about 22,607 units. So that's the amount of units we would have to sell before we start making a profit. The second way we can look at break-even analysis is to look at the net income break-even point. So this is the point at which a firm's net income is zero. The formula for the break-even quantity for net income is Q star equals the fixed cost plus the interest expense divided by the price per unit minus the variable cost per unit. And the formula for the break-even sales amount or dollar amount for net income break-even is S star equals the fixed costs plus the interest expense divided by 1 minus the variable cost per unit divided by the price per unit. So finding the net income break-even point is almost identical to finding the EBIT break-even point, except that you must account for the interest expense. A firm's capital structure also affects its riskiness. To see how, first consider the standard CAPM equation. The rate of return on a stock equals the risk-free rate plus the rate of return on the market minus the risk-free rate. Remember, sometimes we call this whole quantity right here the market risk premium, and then we times that by the beta of the firm. And here I put L just for the beta for a levered firm. If it were unlevered, then there would be no additional effect on the riskiness of the firm, so you could just put in beta unlevered here, but we'll see why I put in levered here in a second. So we know from our earlier discussion on the cost of capital, when we were talking about the cost of capital, that the following relationship holds between the beta of a levered firm, that means one with debt, and the beta of an unlevered firm, or one that's all equity. The beta of a levered firm equals the beta of an unlevered firm plus the beta of an unlevered firm times 1 minus the tax rate times the debt to equity ratio. If we substitute this equation right here, all in, to the above equation for the beta of the levered firm in our CAPM equation, this gives us the rate of return, the required rate of return on a stock of a levered company equals the risk-free rate plus the market risk premium times the beta of an unlevered firm plus the market risk premium times the beta of a levered firm. And so we can actually break these down into two different components, and we can say that the required rate of return on a firm's stock equals the risk-free rate plus a business risk premium, underlined in blue, which represents this part. That's the risk that's present in any firm, whether or not it's levered. So there are certain risks that firms that have debt and firms that don't have debt face, and they're similar across all firms, and that's what we're talking about when we're talking about business risk. It's just the risk that's inherent in every firm based on uncertainty. But then we have this other premium. It's called the financial risk premium, underlined in red, and that represents this term right here. It's the market risk premium times the beta of the levered firm, and that accounts for the fact that the firm is using debt to finance its operations, which means it's more risky. So we can break up the required rate of return for shareholders into these two different components and then add the risk-free rate. So let's look at an example. Suppose a firm currently has $10,000 of debt and $50,000 of equity, and its beta is 1.1. The risk-free rate is 2%, and the market risk premium is 5%. So at this point, we could easily show that the required rate of return on the firm's stock is 7.5%. That would just require us to plug in the beta of 1.1 times the market risk premium and then add that to the risk-free rate. So that'll give us the required rate of return on the stock right now for this firm with this capital structure at 7.5%. So now assume that the firm wants to change its capital structure to 50% debt and 50% equity. So we're going to be increasing the amount of debt we have. Find the new required rate of return on the firm's stock, assuming a tax rate of 30%. So we need to find the firm's new levered beta. To do this, we first need to unlever the old beta, and then we can relever it at the new capital structure. So the important thing to remember here is if we're starting off with a beta of a firm that's levered, which we are because the beta is given as 1.1 and we know that there's debt to start out with. So that's a levered beta. It's a beta of a firm that already has debt. If we want to get the beta of a firm at some new target capital structure, we first have to unlever it to get rid of that financial risk that's inherent in the firm already, and then we relever it at a capital structure. So you have to remember that whenever going from a beta of one levered firm to the beta of another levered firm, you first have to unlever it. So let's do that now. To unlever the old beta, we can just solve the beta equation for the unlevered beta. This was the equation that we had, the relationship from our discussion on the cost of capital earlier, and it said that the levered beta was equal to this expression. If we just factor out beta sub u, the unlevered beta, and solve for it, we're going to get this equation. The unlevered beta equals the levered beta divided by 1 plus 1 minus the tax rate times the debt to equity ratio. So now we just plug in the old debt and equity values, the levered beta, and the tax rate, and we can find what the unlevered beta is. So again, this was the old levered beta, 1 divided by 1 plus 1 minus the tax rate. The tax rate is 30%. The amount of debt we had was $10,000, and the amount of equity was $50,000. So another important thing to remember is right here, the debt to equity ratio. Sometimes it's given us in terms of a percentage, and sometimes it says we have 20% of debt or 30% of debt and 70% of equity, or some combination of percentage terms. The important thing to know is that because it's a ratio, we can just put those percentage terms in there as well. So whether or not we're given dollar amounts or percentages, we can put those into that debt and equity ratio, and we'll get the same term at the end. We'll get the same number for the ratio of our debt to our equity. So if we solve this, we find that the beta of the unlevered firm is 0.965. So now we want to relever the beta at the new target capital structure using the original equation that's already solved for the levered beta of a firm. And here it is. The levered beta of the firm is equal to the unlevered beta plus the unlevered beta times 1 minus the tax rate times the debt to equity ratio. Well, the unlevered beta we just found, that was the 0.965. So we plug that in for beta unlevered here and here. The tax rate is 30%. The debt amount on our new capital structure, we said we wanted 50% debt, 50% equity. So remember, we can just plug those directly in. The amount of debt is 50%, that's 0.5. The amount of equity is 50%, that's 0.5. That number will be 1, which means our debt to equity ratio, for every dollar of debt we have $1 of equity. That's what that means. We evaluate this expression. We find that the levered beta at the new target capital structure is 1.64. So finally, we can plug this beta into CapM and solve for the investor's new required rate of return on their stock, given this new capital structure. We just use the standard CAPM equation. The rate of return required on stock is equal to the risk-free rate plus the market risk premium, which is 0.055% given in the question, times the new levered beta of 1.64. That gives us a required rate of return equal to 10.2%. And that's the end of part 1.